Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this hour with stocks steady and bond yields moving lower. Investors focusing on President-elect Donald Trump's first day in office. Miskin of John Hancock saying we are likely moving to a new macro regime here as we have to say goodbye to Goldilocks. Before, the data was not too hot and not too cold, which left the Fed supportive to markets. Now the data is coming in hotter nearly across the board. Matt joins us now for more. Matt, welcome to the program. Did this week change things for you in any way, shape or form?
The Philly Fed index, John, was through the roof. I mean, it's a little too sunny in Philadelphia right now, it almost seems like. And when you see across the board, I mean, the NFIB survey also, I mean, some of these moves in the economic data almost look like meme stocks in terms of their parabolic upside. And when you see this, and then you hear the Fed, or FOMC members like Waller, as you've been addressing, saying they're still going to be cutting, it's hard to put those two pieces together. But at the end of the day, you got to position more for a reacceleration of growth. We're looking down in cap, mid-cap stocks, industrials. We've been talking about them for a long time. But frankly, the earnings are looking good. They're starting to get more appreciation, relative strength. And if there's more onshoring CapEx, that's our favorite place to be in global equity.
So, Matt, let's build on that. How further down in market cap would you come, and would you go down to small caps? And let's just talk about the Russell. Can small caps work without interest rates coming down?
We don't believe so, John. And that is the big difference about reading this macro regime. It's almost like the macro regime playbook is missing pages here, or the pages are so dated you have to go back and get a new edition, because the small cap indices are just different than what they used to be 10, 20 years ago. Now, in a booming economy, 40% of the companies don't make money. And so they really actually would prefer a zero interest rate regime more than a strong economic regime. And mid-cap, on the other hand, 85, 90% are profitable. You're getting more industrial exposure. You're still getting financials, but that industrial exposure typically is higher quality with a higher ROE. So if you want quality and value combined, which is basically our mantra, quality at a reasonable price, we would go to mid-cap. Mid-cap may be the new small cap to implement for this kind of macro regime.
Matt, can I go back to what you're saying about data looking like meme stocks? Peter Schiff of Academy had basically the same read as you, but his conclusion was something is wrong with the data, that you can have a jobs report that comes in and 74 out of 75 economists have a number in expectation below 200,000, yet it surprises to the upside. Is there a factor that maybe the data, as hot as it's showing, is just not correct?
It could be. I mean, you know, at the end of the day, these are surveys, and surveys have been the hardest thing to read over this whole cycle. Since COVID, basically surveys have been broken. Leading economic indicators, surveys that are trying to lead the economy have just frankly been wrong. They were overly pessimistic over the last couple of years as the economy chugged along pretty well, and now they've really whiplashed into more positive, kind of more optimist type outlooks. Now, does real GDP improve? Does other activity improve? We'll just have to see. But you've seen such a flip of the switch on survey data. At the end of the day, though, we're seeing it in markets. I mean, even just to start this year, I think in the best way, you know, LL Cool J may have said it best, don't call it a comeback. You're seeing the markets rotate. Industrials, financials, materials are all starting to do better. Tech isn't working. I know this is like stunning for markets after 2 years of just tech domination, but a rotation's happening in markets, and that's reflecting probably what's happening in the economy, a better economic outcome.
I mean, you see that with an S&P that declines yesterday. Even so, 75% of the constituents of the S&P were up yesterday. The equal weighted is on track for its second best week over the past year. The only week that was better was after the inauguration of Donald Trump. Matt, how enduring is that broadening? Is that better breadth of the market?
We've been saying that it's got to be an earnings-driven rotation in financials this week. Now, they had low base effects. Q4 of 2023 is when the SVB payouts happened. So that really hurt Q4 of 2023 earnings. And then Q4 of 2024 earnings were strong on top of that. But investment banking, you were all just talking about this. Investment banking businesses are starting to come back and starting to get more strength. We're seeing, the yield curve steepen. That helps financials. Financials are the biggest value sector. It's really tech versus financials if you're trying to make a growth versus value decision, if you're going to see that rotation. But the great news of this week was really actually the fundamental side, and it was all those beats by the big banks.
You say that the Fed is likely done holding markets' hands. So then what do you make of Governor Waller yesterday?
To me, it was an outlier. And this is where it gets difficult listening to FOMC members because they're going to be all over the place. And if this divergence really happens over the next couple months, I don't think it really helps markets. It's just going to add uncertainty. But if you're data dependent, I don't get it. I mean, you just talked about how the CPI report beat by 0.002% and trillions of dollars were moved across markets. And even in this little bit, as soon as inflation comes down a little bit, you get this speculative frenzy back in things like crypto. And that's not going to help your inflation problem or your kind of that speculative nature or sentiment of markets.
So Matt, let's address it. Can I just jump in? Is Governor Waller data dependent, or is he Fed chair vacant seat dependent?
I think that's the latter. I think there's other motives. But, at the end of the day, over the course of the year, I think he could be right. I think the way we're looking at this is a two-half story for Fed in 2025. The first half, I think they have to be hawkish. I think they have to back off and let the economy settle in, see what happens. And in the back half, I do think they're going to be cutting. But it's hard to say right now, look, we're going to get it in the first half. I think you're just kind of bringing forward an inflationary impulse that you really would rather not have up front here as we're going to reset into the beginning of 2025, a lot of the inflation. And commodities are coming back. That makes me a bit nervous on the inflation front, but it helps the cyclical side of equities. And that's what we're leaning into.
Well, Matt, let's stick with commodities for a minute. Scott Bessent yesterday took a moment to directly say if any Russian officials are watching his hearing right now, they should be on guard that potentially they will go after the biggest Russian oil producer, something we saw Biden do in the very last days of his administration. Did you get a sense that actually we're going to get a very hawkish Donald Trump administration when it comes to Russia and sanctions coming into office very shortly?
I did not see that on the 2025 bingo card. But what we're seeing, yeah, you're right. I mean, and it's just interesting to see that the administration really waited to the end to kind of throw on these sanctions. And that is really where oil prices started to respond. Before, all the other sanctions or other supply issues was just kind of breezed over. I mean, WTI was more like $70. It's kind of breaking that. It almost looked like it was going to break down even further. And then it just really has rallied here. If you wanted disinflation, that oil rise is not good news. But at the end of the day, look, commodities work in these kind of short-term spurts. Even copper is ripping. I think this also has to do with getting ahead of the tariffs more broadly and just trying to get as much inventory, whether it's supplies, finished goods, ahead of this as possible. You've seen it in the China data. China's basically having this huge export data. They need the commodities to do it. But I don't know if it's really sustainable. Frankly, we believe inflation is going to come down over the course of the year. We think housing prices moderate. So we would actually use this impulse and lean against it, actually maybe grab a little bit of duration here.
I mean, it's a lot, Matt. And only the 17th day so far of 2025. You'd think people would welcome a long weekend, but everybody's going to be glued to their screens waiting to see what happens on Monday in terms of executive orders. What's your read on how vulnerable the market is to any sort of action from Trump, be it on immigration or tariffs?
Right now, we're pricing in a lot of good news, and sentiment has really skyrocketed to be more positive. I think more broadly, what we're seeing is the biggest liability to this market is the positive sentiment. One of the best things this markets had going in to the last year or so was that it was pretty bearish. And the new administration has brought a lot of hope, a lot of optimism. Not necessarily a bad thing. Again, that's probably driven some economic activity and more CapEx. deregulation, all that. But at the same time, you got to be careful here, looking for everything to go right and thinking that, it's all going to be kind of an easy way to navigate this macro backdrop. There is still policies that could, kind of dent some economic growth. There is policies that could create volatility. So at the end of the day, you still got to think about risk management. And again, that would bring us to the bond market.
Matt Miskin, making tears rain down like a monsoon. Appreciate it, sir, of John Hancock. Here's the latest this morning. Trump's Treasury pick, Scott Bessent, urging Congress to extend 2017 tax cuts, warning their expiration would mean an economic crisis. Bessent appearing on track for confirmation without specific objections from Democrats during yesterday's hearing. Joining us now, Isaac Boltansky of BTIG. Hey, Isaac, welcome to the programme, sir. We need to talk about executive orders and Trump Day 1. I just want to get your thoughts on yesterday. How do you think Scott Bessent did?
Look, I think it's clear that Scott Bessent is a mind at work, and I think that markets should be heartened by that, as I think all of us would like a steady hand in that role, someone with his experience in the Oval Office advising the president. But John, let's not kid ourselves, right? We are still going to be living and dying day to day by whatever Donald Trump is typing out on his phone's keypad. So I think that it's heartening and positive, and Bessent's going to be easily confirmed, and he's going to be a stable voice in the Treasury Department and ultimately in the Oval Office advising the president. But the president himself is going to decide what tariffs are going to go into place and how those are going to be communicated to the market.
So we're expecting some 100 executive orders after Donald Trump is sworn in. Isaac, what do they look like?
I think it's going to be a busy day. I think that there's an enormous amount of anticipation around what we're going to see on Monday. I do want our clients in general to be aware that just because it doesn't come out Monday doesn't mean it's not going to happen. I think that there is a bit of a logjam there in terms of all the different things they want to do. From my seat, I think you're going to see a fair amount of paper focusing on immigration and border security. I think that that's one area where he's consistently said he wants to focus, and I think that there's some administrative levers that he can pull. My cautionary point there is I think that that's going to be one area that you see heavily litigated. So that's one area and one dynamic that we're aware of. I think you're also going to see a fair amount of orders on the energy front and the healthcare front. Those have less risk of litigation, generally speaking. So we'll be keeping our eye on that. And of course, there's a lot of signaling, Anne-Marie, right? We're going to have a lot of things that don't actually have teeth, a lot of things relating to the culture wars and things that I don't think that the markets are going to have to worry about all too much.
And the signaling's on the other side as well. Biden is continuing a ton of executive actions, even as staffers are starting to pack up their offices currently, right now. When it comes to tariffs, though, will we get executive orders next week?
I think that we're going to get a few. And look, my base case here is still that there's going to be an overarching incrementalism to the tariff policy from the Trump administration. I think that they are cognizant of the economic impact. And I think ultimately they still want tariffs to be used primarily as a negotiating chit. And the way that I think about this is for those negotiating chits to have any value, you still need to prove that you're willing to shoot the hostage, if you will. And so from a framing perspective, I think that ultimately they will move quickly on instituting new Chinese tariffs, likely using Section 232 or Section 301, which takes a few months to get there. And then maybe a few acute areas where they focus on issues that they have a fair amount of political backing for, things like going after European autos. But I don't expect the broad-based universal tariffs to be where we start from.
You make a good point that this is really year 5 of Trump, not year 1. But what is going to be different from 1.0 to 2.0?
Yeah, look, I think Anne-Marie, it's a lot of amplification, right? So we know there's going to be a deregulatory agenda. We know there's going to be a focus on tax cuts and border security. But there's an amplification of some of those issues. So on border security, it's not just focusing on the border. It's also the deportation dynamic that's in play. On the tariffs, I think that they have more of an awareness of the different tools, which is why you're hearing so much more about IEEPA, which allows the president to impose tariffs based on national emergency. That's something that they didn't really get their arms around until probably halfway through the first term. So in general, I would just say it's more awareness of the levers of power, and then also it's the personnel they have around them. You have very well vetted, truly loyal folks around the president, which should allow them to move a little bit more quickly, and I think ultimately avoid some of the potholes that they fell into during the first administration.
Well, Isaac, to your point, though, they need to show a willingness, in your words, to shoot the hostage, to do the most of extreme measures in order to use it as a negotiating chit. Do you think that that's well enough appreciated? Is this administration that would be willing to go to the extremes?
You know, look, it depends. It depends which client I'm talking to, but I think that there's at least an awareness that the China tariffs are something that he is absolutely serious about. There's a fair amount of debate among the client community that I speak to as to whether there can be a grand bargain with China over time, but I think that we need to have that as our base case, that China is going to be where he moves quickly. Canada and Mexico, I truly think, are more about a conversation, more about one-off negotiations than anything else. And on the European side, I do think that he is a true believer, especially on the auto story. So I think what we have now is sort of trying to understand that bridge from rhetoric to reality and trying to get into Donald Trump's mind and the mind of those who are running this administration as to what they're really going to prioritize, because it's clear they can't do everything. So what is their prioritization hierarchy on tariffs?
Well, as Anne-Marie started this hour saying, Scott Bessent yesterday laid out several different use cases for tariffs. One of them that seemed to keep coming up was this idea of tariffs as national security, that sanctions pressure the dollar and its reserve status, and it makes more sense to use, therefore, instead tariffs. When it comes to China, Isaac, what is the strategy? Is it negotiation, or is it one of national security, and that's why tariffs would be put on?
Yeah, look, I think that it's a full court press. That's how I think about it. And I think that there's more awareness here than there's ever been in terms of we need to have more of a holistic approach in terms of our competition with China. And you heard it yesterday during the hearing. I think it was noteworthy to hear how much was referenced in terms of our outbound investment screening. Look, we have screening for if foreign entities want to buy interest in the U.S. We should also have some awareness and some say as to outbound investment and what that means for acute areas of competition. And I think that it's one of the few areas of bipartisanship. And so we've got to be aware of how that's playing, not just politically, but also operationally in terms of the different levers of government they have, from CFIUS, which we've seen with the U.S. Steel deal, to acute areas of legislation like we've seen with the TikTok ban.
Isaac, the horse has bolted. The technology's already lost. I wish we were having this conversation 20 years ago, but we're not. And then I started to hear things like the TikTok CEO's coming to the inauguration. She's invited to the inauguration, not turning up, by the way. Isaac, what is going to be the approach to things like TikTok? If it is seriously a national security risk, and Chinese hackers have infiltrated the Treasury, and they don't care who's in charge, they could possibly do the same thing in the incoming administration as well. I don't really understand what the holdup is.
Well, look, I'm confused by Congress passing a bill saying that they want to ban TikTok, and now at this 11th hour, seeing many of those lawmakers from both sides of the aisle retracting their previous statement, saying we would love a reprieve, we would love to find a way to push this ban out. And so I think that there are always those political wins which are tough to dissect. But by and large, when I try to step back and say, what does this actually mean for markets? What does this mean for investors? Is one of the persistent tailwinds that I see from a spending and a appropriations area is we're going to spend a whole lot more money on cybersecurity as a federal government. There's going to be a whole of government approach to cybersecurity that is frankly 20 years too late. But in terms of areas that clients ask, where are we going to plus up spending? Yeah. Where are we going to spend more and more, no matter who is in charge of that pen? It's cybersecurity and overall just defense and national security.
Forgive me for putting you on the spot, but what do you actually think happens with TikTok in the next week, Isaac? What's your base case?
Look, I think that we're going to get the Supreme Court order today. They have a release this morning. My base case has been that when you can bet on D.C. taking longer than it should, it will. I think that the Supreme Court is likely to say that they're going to continue deliberating on this. There's going to be a temporary injunction for a couple months while they do so, and that we get their order, I think, ultimately upholding the statute, which is negative for TikTok, but we're going to have to wait a couple months before that comes out.
Isaac, good to catch up with you, sir. Appreciate it. Busy week next week for sure. Thank you. Isaac Boltansky of BTIG. So here's the latest this morning. Markets bracing for President-elect Donald Trump's trade policies. The dollar hovering near two-year highs as tariff uncertainty weighs on global currencies. Foley of Rabobank writing, Trump may be prepared to back down on his previous preference for a weaker US dollar, particularly if he views that tariffs can do the heavy lifting on addressing the US trade imbalance. Jane joins us now for more. Jane, didn't work last time. Can it work this time?
Well, I think things are a little bit different this time, and I think we know that Trump is an experienced politician. He's also, I think, ready to hit the ground running next week, and I think this time next week we'll be able to answer that question with a lot more clarity, because if he comes through very quickly with executive orders, the market's going to get a very strong flavour as to whether or not what it's priced in terms of tariffs, in terms of growth, in terms of inflation, is really, broad-based correct or not.
Well, Jane, what do you think is behind the dollar move we've seen? Is it rate differentials off the back of superior economic growth and inferior growth abroad? Or is it really about anticipating the policy changes from the incoming administration?
It's both. Certainly, if we just take a snapshot of the US economy now and compare it with, for instance, Germany, China, what we see is a lot more strength. For instance, if you look at the forecast for growth in the US this year, they're averaging around about 2%. The consensus is around 2% for the US. It's about half of that for the Eurozone. Obviously, we all know that China's still got growth struggles, even though it did hit its target for 2024. So that there is a better growth outlook. And with that, there is evidence of sticky inflation in the US. So that's the snapshot right now. And on top of that, we need to layer in the potential inflationary impacts of tariffs, of mass deportations, for instance. That could certainly create a more tightness in the labour market, where a very significant proportion of the workers in the US are foreign born. Now, obviously, a lot of those have got documentation, but even so, we could certainly see some inflation or wage prices coming through in certain sectors, so agricultural workers, etc., and some others. So we do anticipate more inflation. The market is anticipating more inflation from Trump, but that's layered on top of what is a pretty robust economy already.
I understand these things are hard to disaggregate. Scott Bessent did take a run at it yesterday when he said for every 10% increase in tariffs, you would see a 4% move in currency markets. Jane, does that math square for you?
It is difficult because who are these tariffs going to be on? What about the tit-for-tat tariffs? There is so much to say. So it's very difficult, I think, to say with any certainty that that's exactly the rule of thumb that we can follow. But one thing that I think is going to be very, very interesting during this, the next few years under Trump is to what extent tariffs are used for foreign policy. Now, we had some indication from Bessent yesterday saying that tariffs could be used for broader reasons. We had Trump a week or so ago in his press conference, talking about the economic power that he could exert on Canada, for instance. To what extent are we going to have this different type of statecraft really under Donald Trump, whereas tariffs are used not just for economic policy objectives in the US, but for foreign policy objectives in the US. And that is a different ballgame, which is very difficult to measure.
It's something Terry Haynes has been writing about at Pangea for some time. Jane, but it's for those uncertainties that you get something like the reporting we've heard out of the Bank of Japan, that officials there do and are leaning towards a hike at the end of next week, but want to wait until Monday, until we get Trump's inauguration, to understand what sort of executive actions he would take. What is the path that Trump might take that would either derail BOJ from hiking or give them the green light?
Well, I presume if Trump were to indicate that Japan was not in the center of the sights in terms of tariffs. But, Japan, I think, is in a very interesting, potentially quite a strong position, because we've got to remember that Japan not only is, the largest holder of U.S. treasuries outside of the U.S., but it's also the biggest provider of U.S. FDI. And, of course, over the last, compared, say, to 30 years ago, the geopolitics between the U.S. and Japan have changed significantly. Whereas, in 30 or so years ago, the U.S. really forced Japan to move away from its semiconductor business if it was going to protect its manufacturing sector, and really forced Japan, to move large auto plants, for instance, into the U.S. Now, Japan sees itself more in certain areas, particularly tech, as more of a collaborator, and that relationship, I think, could be strengthened in areas as defense going forward. So those sorts of indication perhaps give Japan a little bit more strength in terms of the hand that it has got on offer to play against Donald Trump. So certainly not as vulnerable in terms of trade as perhaps China, maybe not even as vulnerable as Germany, for instance. But I think that's going to become a lot clearer over the next few weeks.
And also warming up to the president-elect, Japan will also be sending their foreign minister to the inauguration on Monday. Jane, I'd love to get your thoughts on one thing Scott Bessent said yesterday about sanctions. He said Trump thought that potentially the U.S. has gotten over its skis on sanctions because of de-dollarization. Do you think sanctions are leading to de-dollarization around the world?
Well, if we look purely at just the IMF data, there is not that evidence yet. In fact, if we look back over the last 20 years, there is evidence of de-dollarization. But actually, where central bank reserves have moved into other currencies, it has tended to be maybe the Aussie or the Canada currencies, perhaps, where over the last 20 years there has been some yield, for instance. So there isn't any firm evidence in the IMF data yet. But there does appear to be a logic behind the fact that if you are going to be applied by US sanctions, then it is in your incentive to stop using the US dollar. And we have seen, for instance, China set up its different payment system, for instance. We have seen some more spread of that between its trading allies. So it would appear logical that if you were to issue more and more sanctions, that you will eventually chase countries away from using the dollar. So there is, I think, a logic in that. And therefore, again, it comes back to how far can tariffs be used as a replacement. So this different type of statecraft where foreign policy aims can be used again by tariffs potentially, not just economic policy aims.
Jane, quickly, just before you go, help me out with something before you leave. How do you explain the difference between Governor Waller and President Hancock on the FOMC? Because the Cleveland Fed president is saying things like we still have an inflation problem, monetary policy is only moderately restrictive, and Governor Waller came out in the last 24 hours signaling he's open to plenty of rate cuts in 25. What's that about?
Well, that is surprising, but certainly, we have this in the Bank of England too. We have this in the Bank of Japan. I mean, this is why there is a whole council, making policy decisions. We need all those different points of views. And of course, at the end of the day, it's which way the majority vote will go. And listening to many of the other Fed officials, it would certainly suggest to me that the majority is one of a cautious outlook there, leaving Waller perhaps as an outlier.
Jane, appreciate your time. As always, Jane Foley of Rabobank there on the FX market.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.